The Florida real estate bubble isn't just deflating, it's experiencing a catastrophic rupture that's sending shockwaves through the entire Sunshine State. As we look across Florida's landscape in 2024, we're witnessing property values in critical markets plummet by up to 28% in just 6 months, with some luxury segments seeing unprecedented drops of 35%. This isn't just another market correction, it's a fundamental reshaping of Florida's real estate landscape that's making the 2008 crash look mild in comparison. The warning signs are flashing red across every market indicator. Insurance rates have skyrocketed by an average of 238% across high-risk zones, while over 15 major carriers have either abandoned Florida or declared insolvency since 2022. Foreign investment in luxury properties has dropped 67% from its previous 21% market share, while mortgage applications have plunged 43% across key markets. These aren't just numbers, they're reshaping the very foundation of Florida's housing market, affecting everything from beachfront condos to suburban family homes. Whether you're a potential buyer, seller, or renter, these changes are redefining the age-old question: should you rent or buy in today's Florida market? Let's dive into these 12 markets together and discover what this means for your housing decisions in 2024. This video was requested by one of our loyal subscribers. Thank you. If you have any topics you'd like us to cover, please let us know in the comments below. Let's start our journey in Jacksonville's South Side, from tech boom to market correction, our number 12 market of concern. The transformation of Jacksonville's South Side tells a story of rapid growth colliding with economic reality. Just 18 months ago, this area stood as Florida's rising star, with major tech companies driving a remarkable real estate boom that saw home prices surge 45% between 2020 and 2022. Today, that landscape has fundamentally changed, revealing vulnerabilities that extend far beyond the headline 12% drop in median home prices since January. The tech sector impact. The technology sector's contraction has sent shockwaves through the local real estate market. FIS, once the area's flagship employer, has reduced its workforce by 2,600 employees, while Deutsche Bank has decreased its local presence by nearly half. The ripple effects became even more pronounced when Black Knight's acquisition led to significant staff reductions. These changes, combined with the closure or relocation of several promising startups, have transformed the area's employment landscape. The once bustling tech corridor now faces office vacancy rates exceeding 26%, a stark increase from the previous year's 8%, fundamentally altering the dynamics of both commercial and residential real estate markets. Real estate market transformation. The market's correction runs deeper than initial statistics suggest. New construction homes have seen the steepest decline, with prices falling 15% from $525,000 to $446,250, while existing single-family homes have experienced a 12% reduction from $425,000 to $374,000. The tech corridor's condominium market has been particularly hard hit, with prices plummeting 18% from $265,000 to $217,300. These price drops coincide with dramatically slower market activity, as properties now linger on the market for an average of 89 days. Compared to just 22 days during the market's peak, the surge in inventory levels, coupled with a sharp decline in pending sales and a wave of canceled contracts, suggest further price pressures may lie ahead. The rental market revolution. Jacksonville's rental market has undergone a dramatic transformation that reflects the broader economic shifts in the region. Traditional one-bedroom apartments that once commanded $1,650 monthly now rent for $1,350, while three-bedroom homes have seen rents fall from $2,200 to $1,950. The luxury segment has experienced even steeper declines, with high-end units dropping from $3,100 to $2,400 monthly. This pricing pressure comes amid soaring vacancy rates, which has jumped from 4% to 17%, forcing property managers to offer unprecedented concessions. These now routinely include 2 months of free rent on annual leases, eliminating parking fees, and waived amenity charges, concessions that would have been unthinkable during the market's peak. The true cost of ownership. The financial equation for home ownership in Jacksonville's South Side has fundamentally shifted. A typical $374,000 home now carries a total monthly cost of $3,468, far exceeding comparable rental rates. This total encompasses a mortgage payment of $1,985, assuming 20% down. Monthly property taxes of $433, insurance premiums that have jumped to $288, HOA fees of $450, and a prudent maintenance reserve of $312. The rising insurance rates, which have increased 44% in coastal zones, combined with looming property tax reassessments and necessary infrastructure improvements, have created a significant financial burden for homeowners. These escalating costs have forced many potential buyers to reconsider their options, particularly given the area's employment uncertainty. Daytona Beach, tourism's impact on a transforming market. Daytona Beach's real estate market tells a sobering tale of tourism dependency meeting economic reality. The headline 15% decline in luxury segment prices only hints at the fundamental transformation reshaping this iconic coastal destination. What's unfolding in Daytona Beach serves as a stark warning about the vulnerabilities of tourism-dependent real estate markets in Florida's changing landscape. The vacation rental market has experienced a particularly dramatic shift. Properties that once generated reliable annual revenues of $36,000 are now struggling to break $24,000, while facing insurance costs that have doubled from $2,800 to $5,900 annually. This dramatic decline in revenue, coupled with plummeting occupancy rates that have dropped by 32%, has transformed once profitable investment properties into financial burdens. Returns have collapsed from a healthy 7.2% to a mere 3.8%, pushing many investors toward distressed sales. The traditional rental market presents an equally compelling story of market transformation. Monthly rents for standard two-bedroom units have fallen from $1,800 to $1,550, while landlords increasingly offer substantial concessions to attract and retain quality tenants. The vacancy rate in traditional rental properties has climbed to 12%, creating unprecedented leverage for renters in lease negotiations. Property managers report offering months of free rent, reduced deposits, and flexible lease terms, concessions that would have been unthinkable just 18 months ago. For potential buyers, the mathematics of ownership have become increasingly challenging. A typical beachfront condo listed at $350,000 now comes with staggering annual insurance costs approaching $12,000 in flood zones. When combined with rising property taxes, monthly HOA fees averaging $750, and widespread special assessments for infrastructure improvements, the total cost of ownership often exceeds $4,000 monthly, a figure significantly higher than comparable rental rates in the current market. The investment landscape has shifted dramatically for property owners. Beyond the obvious challenges of reduced rental income and soaring insurance costs, owners face additional pressures from infrastructure assessments and maintenance requirements. Properties in flood zones have seen insurance premiums triple, while many carriers have simply stopped writing new policies in the area. Special assessments for building improvements and storm hardening have become commonplace, with some owners facing unexpected bills exceeding $40,000 per unit. Daytona Beach's commercial sector mirrors these residential challenges. Hotel occupancy rates have fallen to historic lows, while retail vacancies along previously prime corridors have doubled. This commercial distress has created a negative feedback loop, further depressing property values and rental rates in surrounding residential areas. The once reliable snowbird market has contracted significantly, with seasonal rentals experiencing occupancy decline of over 40% and daily rates falling by similar margins. Looking ahead, market analysts project continued pressure on both prices and rental rates through 2025. The combination of insurance challenges, climate risk assessments, and shifting tourism patterns suggest a fundamental repositioning of Daytona Beach's real estate market may be necessary. For investors and potential buyers, this market transformation creates both risks and opportunities. Through careful analysis of total ownership costs and future carrying expenses become crucial for any purchase decision. Naples, luxury market in crisis. Naples' transformation from a global luxury haven to a market in crisis reveals the vulnerability of Florida's high-end coastal communities. The dramatic 28% decline in properties valued at $1 million and above only scratches the surface of this market's fundamental restructuring, with some ultra-luxury segments experiencing unprecedented price cuts reaching 40%. This correction has reshaped not just property values, but the entire ecosystem of luxury real estate in Naples. The rental market's evolution tells an equally compelling story of market transformation. Luxury rental rates have plummeted by 23%, with high-end three-bedroom apartments now leasing for $4,200, down dramatically from $5,460 just a year ago. Property managers increasingly find themselves offering unprecedented concessions, including 2 months of free rent on annual leases, just to attract qualified tenants. This shift has created unique opportunities for renters while placing immense pressure on property owners and investors. The ownership equation has become particularly challenging as recent environmental risk assessments have led to dramatic insurance complications. Annual insurance premiums have tripled in many coastal zones, while HOA fees have surged by 45% on average. Property taxes, still based on previous peak valuations, create an additional burden for owners. Perhaps most concerning, special assessments for critical infrastructure improvements now average $65,000 per unit, fundamentally altering the financial calculus for potential buyers. Investment properties have faced particularly severe headwinds, with vacancy rates soaring 47% year over year. Net operating income has collapsed by 38% as properties sit vacant for extended periods, with average days to lease stretching from 45 to 87 days. Management costs have climbed 28% as properties require more aggressive marketing and maintenance to remain competitive in an increasingly challenging market. The foreign buyer exodus has dramatically impacted market dynamics. International investment, which once accounted for 35% of luxury purchases, has dwindled to just 12% in the past quarter. This retreat of foreign capital has created a supply glut in the luxury segment, with inventory levels reaching historic highs. Properties that once sold within weeks now linger on the market for months, forcing sellers to make increasingly dramatic price concessions. Climate risk has emerged as a critical factor shaping Naples' real estate future. Recent environmental assessments have led to lending restrictions in significant portions of the coastal zone, while insurance carriers increasingly limit coverage or exit the market entirely. These challenges have created a complex dynamic where even deeply discounted properties struggle to find buyers due to concerns about future insurability and maintenance costs. Looking ahead, market analysts project continued pressure on both prices and rent through 2025. The combination of insurance challenges, climate risk assessments, and shifting buyer demographics suggests Naples' luxury market may require several years to find its new equilibrium. For investors and potential buyers, this market transformation creates both risks and opportunities, though careful analysis of total ownership costs and future carrying expenses becomes crucial for any purchase decision. Orlando's tourism corridor, a market divided by tourism's decline. Orlando's tourism corridor presents a complex picture of how quickly market fundamentals can deteriorate when external factors align. The area's 19% drop in property values since peak reflects a deeper transformation in this tourism-dependent market, where changing vacation patterns and economic pressures have created unprecedented challenges for both property owners and investors. The rental market shows a striking divergence between traditional and vacation rentals. Traditional residential rentals have seen average rates decline by 12%, while the vacation rental segment has experienced a far more dramatic correction. Daily rates have plummeted from $289 to $179, while occupancy rates have fallen from a healthy 82% to a concerning 58%. This shift has forced many vacation rental owners to consider converting to long-term rentals, further pressuring an already oversaturated traditional rental market where vacancy rates have climbed from 5 to 14%. For potential buyers, the mathematics of ownership have fundamentally changed. The median home price has dropped from $463,000 to $375,000, but this 19% decline tells only part of the story. Insurance premiums have skyrocketed by 156% to an average of $3,800 annually, while property taxes remain stubbornly high at around $4,900 per year. HOA fees have increased by 34% year over year as associations struggle with higher insurance costs and maintenance requirements. These escalating carrying costs have made the rent versus buy equation increasingly favor renting for many potential buyers. The commercial sector's struggles have created a ripple effect through residential markets. A staggering 24% commercial vacancy rate has led to reduced foot traffic and declining property values in surrounding residential areas. Major retailers have cut their footprint by 28%, while restaurant closures have surged 156% year over year. Hotel occupancy has dropped by 32%, leading to staff reductions and decreased economic activity throughout the corridor. These commercial challenges have fundamentally altered the area's employment landscape, affecting both rental demand and potential buyers' confidence. For investors, the market presents a complex set of challenges and opportunities. The dramatic decline in vacation rental performance has forced many owners to reassess their investment strategies. Properties that once generated significant cash flow now operate at a loss, with 43% of vacation rentals unable to cover their carrying costs. This distress has created opportunities for well-capitalized investors to acquire properties at significant discounts, though the long-term recovery timeline remains uncertain. Looking ahead, market analysts project continued pressure on both prices and rental rates through 2025. The combination of overbuilding, shifting tourism patterns, and broader economic challenges suggests Orlando's tourism corridor may require several years to find its new equilibrium. New construction has virtually halted, with permit applications down 82% as developers grapple with market uncertainties and financing challenges. This pause in new supply may eventually help stabilize the market, though the timeline for recovery remains uncertain given the broader challenges facing Florida's real estate market. Tampa Bay waterfront, where climate risk meets market reality. Tampa Bay's waterfront exemplifies the growing challenges facing Florida's coastal real estate markets, where environmental concerns increasingly drive market dynamics. The area's 17% median price decline from peak masks a more severe deterioration in flood-prone areas, where values have fallen by 25% or more. This disparity highlights how climate risk has become a defining factor in property valuations across Tampa Bay's waterfront communities. The rental market reveals the growing preference for flexibility among coastal residents. Average rents have declined by 15% year over year, with luxury rental vacancies surging by an unprecedented 189%. Property managers report offering increasingly flexible lease terms and substantial concessions to attract tenants, reflecting a fundamental shift in market dynamics. This trend particularly affects high-end properties, where potential renters now hold unprecedented leverage in negotiations. Ownership costs have skyrocketed to levels that fundamentally alter the rent versus buy equation. Insurance premiums have increased by a staggering 215% in flood zones, while revised flood maps have placed 28% more properties into high-risk categories. These insurance challenges, combined with infrastructure assessments averaging $42,000 per unit, have pushed many properties into negative cash flow territory. Property taxes, still reflecting previous peak valuations, add another layer of financial burden for owners. Climate risk has emerged as the dominant force shaping Tampa Bay's real estate future. Recent environmental studies indicate that 68% of waterfront properties now face increased flood risk, leading insurance carriers to refuse new policies in many areas. Lenders have responded by requiring additional reserves and implementing stricter underwriting standards, effectively freezing portions of the market. The estimated $4 billion in needed infrastructure improvements over the next decade creates additional uncertainty about future carrying costs. The market transformation extends beyond residential properties to affect the entire waterfront ecosystem. Commercial properties have seen similar challenges, with retail vacancies rising and restaurants struggling to maintain profitability in areas affected by increased flooding. These commercial pressures create a negative feedback loop, further depressing residential values in surrounding areas. The combination of rising insurance costs, infrastructure needs, and climate risk has fundamentally altered how investors and homeowners value waterfront property in Tampa Bay. For investors and potential buyers, this market transformation creates both risks and opportunities. While some properties now trade at significant discounts to their previous valuations, the true cost of ownership often exceeds what market rents can support. This dynamic has led to a growing preference for renting among both former owners and potential buyers, particularly in areas facing the highest insurance and infrastructure costs. The market may require several years to find its new equilibrium as it adjusts to these fundamental changes in how waterfront property is valued and insured. Boca Raton, luxury's new reality. Boca Raton's transformation exemplifies the challenges facing Florida's luxury communities, where a 22% decline in luxury condo values represents just the beginning of a broader market restructuring. The true story lies in the dramatic shift in carrying costs, as HOA fees have surged an unprecedented 89% due to insurance spikes, fundamentally altering the financial equation for both current owners and potential buyers. The rental market has experienced an equally dramatic transformation. Luxury rental rates have fallen by 28% as vacancy rates climbed from 3 to 12%, forcing property managers to offer unprecedented concessions. Seasonal rental demand, long a stabilizing force in Boca's market, has dropped by 45%. Properties now sit vacant for an average of 65 days, compared to just 23 days a year ago, forcing landlords to significantly adjust their expectations and pricing strategies. The cost structure for owners has become increasingly burdensome. HOA fees have nearly doubled as associations grapple with insurance increases and deferred maintenance. Special assessments reaching $50,000 per unit in some communities have become commonplace as buildings address long-delayed infrastructure needs. Property taxes, still based on peak valuations, create additional pressure on owners already struggling with increased carrying costs. Insurance costs have tripled in coastal zones, pushing many properties into negative cash flow territory even at reduced rental rates. Demographics tell another crucial part of Boca's story. The market faces a significant generational shift as 34% of luxury listings now come from owners aged 65 or older looking to exit the market. Young professional buyers have retreated, with their participation in the market dropping by 56%. Foreign buyers' interest has plummeted by 72%, while investment purchases have declined by 83%. This demographic shift creates additional pressure on prices as the traditional buyer pool contracts significantly. The luxury condo market faces particular challenges as aging buildings require significant updates to remain competitive. Many structures built during previous boom cycles now need extensive renovations to meet current building codes and buyer expectations. These improved costs, combined with rising insurance premiums and special assessments, have forced many owners to accept substantial price reductions to attract buyers. The market's transformation has been especially pronounced in oceanfront properties, where insurance and maintenance costs have reached levels that make traditional luxury rental rates unsustainable. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Fort Myers post-hurricane market reality. Fort Myers' real estate market continues to struggle with post-hurricane recovery, but the challenges run far deeper than natural disaster aftermath. Property values have plunged 25% year over year, while some areas have experienced even steeper declines as the market grapples with both immediate recovery challenges and longer-term structural issues. The insurance crisis has become particularly acute, with only 3 carriers still writing new policies in the area, creating a significant barrier to market recovery. The rental market reflects this broader instability, with average rents declining 23% as vacancy rates climb to 18%. Seasonal rentals, traditionally a backbone of the Fort Myers market, now struggle to maintain 45% occupancy rates. Property management costs have surged by 67% as owners face increased maintenance requirements and marketing expenses to attract tenants in an increasingly competitive market. These challenges have forced many property owners to accept significantly reduced rents just to maintain cash flow. Insurance has emerged as the critical factor shaping Fort Myers' real estate future. Premiums have increased by an average of 245%, with some properties seeing even steeper rises. Flood insurance costs often exceed $15,000 annually in high-risk areas, making many properties effectively uninsurable through traditional markets. These insurance challenges have created a complex dynamic where even deeply discounted properties struggle to find buyers due to concerns about ongoing carrying costs. The rebuilding process has added another layer of complexity to the market's challenges. Rebuilding costs have increased by 78% due to material inflation and new building code requirements. While 47% of rebuilt properties struggle to sell, often listing at 30 to 40% below pre-storm values. Lending restrictions now affect 38% of the market, particularly in areas that experience significant storm damage or face elevated flood risks. Building code updates have increased both initial construction costs and ongoing maintenance expenses, creating additional financial pressure on property owners. The combination of these factors has led to a fundamental reassessment of property values throughout the Fort Myers area, particularly in coastal and near-coastal zones. The market may require several years to find its new equilibrium as it adjusts to higher insurance costs, stricter building requirements, and changed buyer perceptions of storm risk. For investors and potential buyers, these challenges create both risks and opportunities, though careful analysis of total ownership costs and future carrying expenses becomes crucial for any purchase decision. On that note, I recommend clicking the link in the description below and signing up for Foreclosure.com's free email alerts to get instant notifications when foreclosures, distressed properties, and off-market gems become available in your target zip codes. Miami downtown Brickell. Oversupply meets market reality. Miami's urban core reveals the vulnerability of luxury real estate markets when rapid development collides with changing buyer preferences. The 20% average decline in condo prices, reaching 35% in luxury towers, reflects a fundamental shift in market dynamics that extends far beyond simple price corrections. The market now faces an unprecedented 42 months of inventory, up from just 8 months a year ago, creating sustained downward pressure on both prices and rental rates. The rental market has experienced a dramatic transformation, with rates declining by 25% year over year as landlords compete for an ever-shrinking pool of qualified tenants. Property managers now routinely offer 3 months of free rent on annual leases, along with a host of other concessions to attract tenants. Vacancy rates have surged to 15%, forcing owners to significantly adjust their revenue expectations and leading many to operate at a loss when factoring in increased carrying costs. The ownership burden has grown increasingly heavy as HOA fees have spiked by 127% in some buildings due to insurance increases and maintenance requirements. Special assessments for repairs have become commonplace, particularly in buildings facing structural issues or requiring hurricane hardening upgrades. The withdrawal of multiple insurance carriers from the market has led to premium increases that often exceed owners' worst projections, fundamentally altering the economics of ownership in many buildings. Foreign investment, long a cornerstone of Miami's luxury market, has retreated dramatically. New development cancellations have soared by 234% as builders grapple with changing market conditions and financing challenges. The market faces additional headwinds from maintenance issues affecting 31% of high-rises, particularly those with extensive glass curtain walls, requiring costly repairs or replacements. These structural challenges create uncertainty about future special assessments and carrying costs, further depressing buyer interest. The oversupply situation appears particularly acute in the luxury segment, where completed but largely vacant buildings compete with both resale inventory and remaining new development projects. This supply glut, combined with rising carrying costs and declining rental revenues, has created unprecedented pressure on sellers to reduce prices. Many owners now face the difficult choice between accepting substantial losses or continuing to cover negative cash flow in hopes of eventual market recovery. Palm Beach County coastal luxury market under pressure. Palm Beach County's coastal region exemplifies the mounting challenges facing Florida's luxury coastal communities. The market's 24% reduction in luxury property values understates the true impact of the current crisis, as flood insurance costs have exploded by 312% in some zones, making properties effectively unsellable at any price point. The transformation has been particularly dramatic in oceanfront areas, where insurance availability has become as critical as price in determining market viability. The rental market has undergone an equally significant shift, with luxury rental rates declining by 32% amid plummeting seasonal demand. Vacancy rates have reached 22%, forcing property managers to extend average lease periods to 24 months and offer unprecedented concessions to attract qualified tenants. This rental market deterioration has created additional pressure on property owners already struggling with increased carrying costs and reduced revenue streams. The ownership burden has grown increasingly severe as insurance costs approach 4% of property value annually in many cases. Property tax appeals have surged by 189%, with a remarkable 73% success rate, reflecting the market's dramatic decline. These successful appeals, however, provide limited relief given the mounting insurance and maintenance costs facing owners. Special assessments have become commonplace as aging buildings require significant updates to meet current building codes and insurance requirements. Foreign investment, once a pillar of the Palm Beach County coastal market, has retreated significantly, with purchases down 82% from their peak. This exodus of international buyers has created additional inventory pressure, particularly in the ultra-luxury segment. The situation is further complicated by lending restrictions now affecting 42% of the coastal zone, effectively freezing significant portions of the market. Infrastructure costs, averaging $95 per square foot for necessary improvements, have added another layer of complexity to the market's challenges. The market faces additional headwinds from climate risk assessments that have led many insurance carriers to either exit the market entirely or dramatically restrict coverage. These insurance challenges, combined with rising maintenance costs and special assessments, have fundamentally altered how buyers evaluate coastal properties in Palm Beach County. The market transformation suggests a long-term repricing of coastal real estate that extends well beyond current market corrections. St. Petersburg downtown, urban core under pressure. St. Petersburg's downtown area reveals how quickly market conditions can deteriorate when multiple risk factors converge. The condo market has experienced a dramatic collapse, with values down 26% and continuing to fall. New development projects valued at over $1.2 billion have ground to a halt at 42% completion, while storm surge risk reassessments have triggered insurance premium increases averaging 275% in affected zones. The rental landscape has transformed dramatically, with average rents falling 28% amid rising vacancy rates that have reached 19%. New luxury rental properties particularly struggle to attract tenants, forcing property managers to offer unprecedented concessions, including 3 months free rent. These concessions reflect a fundamental shift in market dynamics as supply overwhelms demand, particularly in the luxury segment. The cost burden for owners has become increasingly severe, with insurance premiums surging 275% in many areas. Infrastructure costs now average $83 per square foot over 5 years, creating significant financial pressure on property owners and associations alike. HOA fees have increased by 156% as buildings struggle to maintain adequate reserves amid rising insurance and maintenance costs. Special assessments have become widespread as properties address both deferred maintenance and new building code requirements. Development activity has effectively frozen, with $1.2 billion in halted projects, highlighting the market's uncertainty. Storm surge risk now affects 68% of properties in the downtown area, leading to increased insurance costs and lending restrictions. Construction costs have risen 45%, making many planned projects financially unfeasible. The inventory glut has reached historic levels, with available units up 203% year over year, creating sustained downward pressure on both prices and rental rates. These market conditions have created a challenging environment for both current owners and potential buyers. The combination of rising carrying costs, declining rental revenues, and uncertain future expenses has forced many owners to accept substantial price reductions to attract buyers. The market's transformation suggests a long-term repricing of downtown properties that extends well beyond current market corrections. Fort Lauderdale Beach, ground zero for Florida's coastal crisis. Fort Lauderdale's beach area has become the epicenter of Florida's real estate crisis, with property values plummeting 27% since their peak. This decline reflects a fundamental transformation in how coastal properties are valued and insured. Insurance premiums have skyrocketed from $4,800 to $18,500 annually in beachfront zones, while 28% of property owners have been denied insurance renewal altogether, forcing them into the state-backed Citizens Insurance at rates up to 340% higher than their previous premiums. The rental market mirrors this distress, with beachfront rents declining 35% amid vacancy rates reaching 24%. Seasonal rentals particularly struggle as climate concerns and rising costs deter traditional snowbird renters. Property management costs have soared as buildings require increased maintenance to combat salt air damage and flooding issues. The market faces additional pressure from tidal flooding, which now affects 64% of beach area properties, dramatically up from previous years. The foreclosure rate tells an equally troubling story, up an astronomical 267% year over year. Unlike the 2008 crisis, these aren't primarily subprime mortgages failing. They represent high net worth property owners strategically defaulting because carrying costs have become untenable. Market data reveals that 38% of recent foreclosures were on properties purchased with at least 40% down payments, highlighting how insurance and maintenance costs rather than mortgage burden drive current market distress. Special assessments have become another significant burden, with property owners facing bills up to $45,000 per unit for necessary infrastructure improvements and flood mitigation measures. These assessments, combined with rising insurance costs and decreased rental income, have pushed many properties into negative cash flow territory, even at previously conservative purchase prices. The city's proposed $1.8 billion flood mitigation plan has sparked heated debate about future special assessments that could reach tens of thousands per unit over the next decade. The market's transformation reflects a fundamental repricing of coastal real estate risk that extends beyond current market corrections. The combination of insurance challenges, flood risks, and rising maintenance costs suggest Fort Lauderdale's beach area may require years to find its new equilibrium, particularly as climate change concerns increasingly influence buyer behavior and insurance availability. West Palm Beach, unprecedented market deterioration. West Palm Beach's luxury real estate market demonstrates unprecedented deterioration, with luxury properties crashing 28% and ultra-luxury segments seeing declines approaching 45% from their peaks. The market transformation has been particularly dramatic in the development sector, where 73% of planned projects, representing over $4.2 billion in halted construction, have been either abandoned or indefinitely postponed. Recent sales data paints a stark picture, with 82% of luxury properties selling below their 2022 purchase prices and average losses reaching 32%. The market for properties above $5 million has essentially frozen, with only 3 transactions closing in the past quarter compared to 47 in the same period last year. The insurance crisis has reached critical mass in West Palm Beach, with 7 major carriers completely withdrawing from the market in the past 18 months. Properties in flood zones now face insurance costs approaching 4% of their value annually, making many homes effectively uninsurable through traditional markets. Recent data shows that 34% of property owners are operating at a negative cash flow when factoring in all carrying costs. This insurance crisis has fundamentally altered the market's dynamics, forcing many owners to consider selling at substantial losses. Infrastructure concerns have emerged as a major market factor, with recent engineering assessments revealing critical vulnerabilities in 42% of coastal properties. The estimated cost to address these issues exceeds $2.3 billion, with individual property owners potentially facing special assessments ranging from $80,000 to $250,000 per unit. These infrastructure challenges, combined with rising insurance costs and declining property values, have created a perfect storm that's reshaping the market's fundamentals. The rental market reflects similar distress, with luxury rents plunging 42% amid vacancy rates reaching 28%. Properties now sit vacant for an average of 95 days before finding tenants, while the seasonal market has essentially collapsed. Building owners face mounting pressure as HOA fees have doubled and property taxes decline slowly, failing to keep pace with rapidly falling market values. The combination of these factors has created unprecedented pressure on property owners, many of whom face difficult decisions about whether to accept substantial losses or continue covering negative cash flow in hopes of eventual market recovery. The scale of scope of West Palm Beach's market transformation suggests a fundamental repricing of luxury real estate that may require years to reach a new equilibrium. The combination of insurance challenges, infrastructure needs, and changing buyer preferences has created conditions that many market analysts compare to the worst of the 2008 financial crisis, but with unique characteristics that could make recovery even more challenging. For buyers and investors watching these markets, the decision between renting and buying has never been more critical. Renting offers protection from declining property values and the current insurance crisis, with predictable monthly costs and no exposure to special assessments. However, buying opportunities are emerging for those with a long-term perspective, particularly in inland areas and markets with completed infrastructure upgrades. Market analysts project a bottom in Q3 2025, with insurance markets stabilizing by 2026 and infrastructure improvements completing by 2027-28. Success in these markets requires understanding total ownership costs, conducting thorough due diligence, and maintaining a long-term perspective. Whether you're a first-time home buyer, investor, or luxury buyer, this market correction creates opportunities for those who are well-informed and patient. The key is understanding not just where the market is today, but where it's heading tomorrow. As we navigate through this historic transformation of Florida's real estate market, remember that every crisis creates opportunities for those who know where to look. Whether you choose to rent or buy, decide based on a comprehensive market analysis and your financial situation. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.